Hello and welcome. Today for Accounting for Decisions A, we will be discussing the concept adjusting entries. So what are adjusting entries? So essentially these are entries made into the journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. This is because we have two bases of accounting. The two bases of accounting are accrual and cash accounting. Cash accounting involves recording a revenue or an expense and it is paid for. However, accrual accounting recognizes revenues and expenses when they are actually earned or incurred. So leading from this, by using the accrual basis of accounting and recording revenues and expenses when they are recognized, we follow important accounting principles. That being the matching principle, expenses should be recorded in the period resources are used to generate revenues, and revenue recognition principle. A revenue should be recorded when a resource has been earned. For the rules of debit and credit, we must be aware of the classification of journal entries. When cash is transferred before service is performed, the company has deferred a revenue or expense. When a company earns a revenue or incurs an expense before cash is transferred, it has accrued a revenue or expense. So how do we actually adjust entries? Well, we use journal entries and T accounts to adjust entries. In the following slides, an example of a deferred revenue will be used. So this is our example of a deferred revenue. A company sells 12-month subscriptions of its monthly magazine. On 1st of October, the company receives a total of $1,200 for 12 subscriptions. What would the following entries be? So as we can see, our initial entry represents the trade of goods and services for cash. So we debit cash following our credit and debit rule, as cash is an asset and cash is increasing. However, we credit unearned revenue as unearned revenue is seen as a liability and liabilities are increasing. So now we are actually going to record the revenue as it has been earned. By doing so, we follow the revenue recognition principle that was mentioned previously. So by the end of February, which is the 5th month, they have earned 5/12 of the money or $500. And this is because they have actually provided that service. Okay, so now we need to recognize the earned revenue in the journal entries and T accounts. By doing so, we debit unearned revenue as this revenue has actually been earned, which is decreasing our liability, and we credit subscription revenue because we have actually earned that revenue.